Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. In this video, we're going to hop into the personal tax planning template and answer a question that comes straight from one of your fellow members inside the program. Okay, let's start right here by laying out the fact pattern, and then we will go and put all of this information into the personal tax planning template. So number one, as the personal tax planning template is currently set up for this person, they are looking at approximately $65,000 RMDs during their RMD years. In other words, that $65,000 RMD projection is what this person's RMDs are looking like prior to doing any tax planning. So the first goal that this individual laid out is that they want to perform strategic Roth IRA conversions to the point where they can get their projected RMDs down to a $15,000 annual target. And in order to accomplish that, they are going to start right over here in part one of the plan, and they're going to complete $200,000 conversions on an annual basis. Now, assuming that we can get part one of the plan to work out, then they're going to come over here to part two. And part two of the plan is once they are looking at approximately $15,000 annual RMDs, they are going to utilize QCDs also to the tune of about $15,000 annually by giving to their church or other charitable organizations in order to effectively reduce that $15,000 taxable RMD to zero, again on an annual basis. Now, the next item that this person raised is that these $200,000 annual Roth IRA conversions are going to result in an estimate of about $50,000 in taxes annually on the conversion income. And this person stated in their email to me that their financial advisor says that they can use RMD money to pay the taxes on the conversions. And then finally, the ultimate question was, how do you set all of this up inside of the RCTS tab within the personal tax planning template? And that is what we're going to do right now. So get those number crunch nerd thinking caps on, because we're about to go for an epic ride deep into the very heart of the personal tax planning template. And by the way, if you enjoy this video, please like and subscribe, and let me know in the comments what's going on in your personal income tax planning situation. Also, YouTube has just introduced a brand new feature called YouTube Quizzes. I have decided to test out that feature in conjunction with today's video. The quiz will not interrupt the video, but you can find today's Number Crunch Nerds quiz in the description below this video. And if you want to test your skills, I suggest you hop down there into the description after the video is over. I have included 8 warm-up quiz questions just to get you ready. Plus, I have included at the end 2 mega brain scramblers. By the way, the channel mascot Nerdy, he is betting that nobody will get all 10 of the quiz questions right. So if you're ready to prove Nerdy wrong, hop into the description after this video, get yourself ready with the 8 warm-up quiz questions, and then put your tax skills to the test with the 2 mega brain scramblers. Okay, so here we are inside of the personal tax planning template. We are on RCTS tab number 1, and the very first thing that was stated in the fact pattern is that this person is looking at a taxable RMD of approximately $65 annually during their RMD years prior to doing any tax planning. Now, this person did not provide in their email to me the details about their age or the balances of their IRAs or the investment returns that they are expecting. So I have simply used some estimated numbers such that we can arrive at a taxable RMD right here, which is in the $60,000 to $70,000 range for the entire RMD period. And so that lines up nicely with the starting point that this individual indicated. Now, just as a quick refresher, how do you get RMDs to populate right here on the RCTS tab? Well, the first thing you do is you go to IRA entry tab number 1 if you are working on spouse 1 or if you are a single individual. Then you go right up here to whatever the most recent previous year end was. In this case, this video is being recorded in 2026, therefore the most recent previous year end is going to be for 2025. We then enter the values of all of our pre-tax accounts right here, and then the grand total pre-tax account value right here, in this case 1.215 million, will carry over here to the RCTS tab, and we'll populate right here in the actual 12/31 year-end balance for the prior year, in this case 2025. That is the row that we are working on. And that year-end balance right here will carry up to the beginning balance for the subsequent year. We will apply our projected rate of return that we are using for our calculations. We will layer on contributions and distributions, which are not conversions or RMDs or QCDs if applicable. We will layer on our tentative Roth conversions, which we will do in a few minutes for this example. We will layer on QCDs if applicable, which we will do in a few minutes for this example. And then ultimately the schedule will arrive at a taxable RMD for the years when you are of an appropriate age to have an RMD. And so that is how these numbers right here appear in the schedule. All right, so coming back over here to the fact pattern, this starting point of the $65 annual RMD projection before any tax planning is satisfied. And now we're going to move to the next item, which is part one of the plan, and that is to do $200,000 annual Roth IRA conversions until we arrive at the point where our RMD projections have decreased from the current value of roughly $65,000 down to our targeted value of $15,000. So let's go back over to the RCTS tab and start entering in these $200,000 annual conversions. Right, so we're back over here on RCTS. We're going to start the conversions in 2026, which means our first conversion is going to go into this cell. Now, what are we going to be watching for as we enter these conversions? And the answer is we're going to be trying to get these RMDs down to the $15,000 range. So going back up to this cell right here, I'm going to enter my first $200,000 conversion. I can see that we are now in the, let's say, $50,000 to $60,000 range on RMDs. So we are making progress, but we're not there yet according to the goal of this situation. Now going back up here to 2027, I'm going to enter in another $200,000 conversion. All right, we're still chugging along. We are now in the $40,000 to $50,000 range on RMDs. Going to the next year, let's drop in another $200,000 conversion. We're in the 30s now down here, going for another $200,000 conversion. Now we're down into the 20s. Now if we drop another $200,000 conversion into this cell, let's see what happens. Okay, we are now in the $14,000, $15,000, $16,000 range right here. Obviously, it's never going to be exactly $15,000 or $65,000 or whatever the case is. That's just a round number of approximately what the amounts will be. So I think this looks pretty good for our goal. We are somewhere in the high 14s to the low 16s. That is a nice approximately $15,000 range. And based on our setup and everything that we just went through, it looks like in this situation it took 5 years of conversions at $200,000 a year to get from that $65,000 taxable RMD starting point down to our approximately $15,000 goal. All right, coming back over here to the fact pattern. So we have entered the necessary number of $200,000 annual Roth IRA conversions. So that item is taken care of. We have also dropped our annual taxable RMD during the RMD years to our targeted value of approximately $15,000. So this item right here is taken care of. Now let's hop down here to part two of the plan, which is to use QCDs, also of approximately $15,000 annually, to satisfy the RMD requirements that are being created right here with $15,000 annually, effectively making the taxable RMD zero for all of these years. Let's go to the personal tax planning template and take care of this next QCD item. Okay, so we're back over here on RCTS. This time we're going to be working in the QCD column right here, and I'm just going to assume for this purpose that this individual desires to make the QCDs in the same year as the respective RMDs that it is trying to offset. That, in my view, is the most logical way to do this. So based on what this individual said, we're going to start the QCDs right here with $15,000. QCD is something which can much more easily be a nice round number, certainly as compared to the calculated amount of RMD. And so you can see by doing a $15,000 QCD in this year, the entire amount of previously calculated taxable RMD has been satisfied, and therefore the amount of taxable RMD after the QCD is now zero. Now, based on what this individual said, they are planning to do that for the entire time in which they are in RMDs. So I'm going to drag that $15,000 all the way down down. And we can see that by doing that, the goal of wiping out the taxable RMD entirely has effectively been satisfied. We are slightly off in the sense that the amount of taxable RMD was a little bit higher than the $15,000 mark. There is certainly nothing preventing this person from doing the exact amount. It doesn't have to be a nice round number. It could be 15068 in this year, which would wipe this out completely. The person could simply round up their QCD to, let's say, $16,000. That would take care of the taxable RMD in that year without having to do like a weird amount that isn't a round number. And then if we take the 16,000 and we drag it down through all of these years down here, you can see the process. We can basically figure out the exact amounts or a rounded amount that will be necessary to wipe out the taxable RMD to zero. All right, so coming back over here to the fact pattern, we have satisfied wiping out the $15,000 annual RMD that remained using a charitable giving strategy that involves QCDs coming out of your traditional IRAs. Remember, there is an annual cap on the amount of QCD that you can do. That cap was not applicable in this situation because for 2026, the amount is $111,000. That is per spouse, and that amount is adjusted for inflation now. But again, that was not relevant to this fact pattern. And so for our purposes, we have satisfied this QCD item, which was part 2 of the plan. And now let's go back up here and see what else we have to consider. Okay, so the next item in the fact pattern is this $50,000 of taxes, which is being estimated based on the amount of conversion income. It's $50,000 annually for each year when we did a $200,000 conversion. And this person stated that their advisor says that they can use RMD money to pay these taxes on the conversion income. Now, is this a true statement right here? Can you use RMD money to pay the taxes on conversions? And the answer is yes, this is a true statement, but let's try to make the statement with a little bit more precision, because as written right here, this is a confusing way, in my opinion, to say this, which could ultimately lead to confusion on how to utilize this and also how to set it up within the personal tax planning template. Okay, so I'm going to reword this with more precision, and the way it should read is you can withhold taxes on any IRA distribution, including a Roth conversion. So now, how do we deal with this item within the personal tax planning template? Okay, now coming back over here to RCTS, the first thing I'm going to do is scroll over here toward the right side of the screen. And what we are looking for is this cash flow analysis section and also this Roth IRA tracker over here. So starting with the cash flow analysis section, this section, which consists of just these 3 columns, has a very specific purpose within the RCTS tab. And the purpose is simply to figure out how much withholding you are going to do on your conversion, such that we can figure out how much cash is actually going to end up in your Roth IRA. Now, the first part of figuring out how much withholding you're going to do is to figure out what the incremental tax is on the conversion, which this person already stated in the fact pattern. He is estimating that to be about $50,000. Up here in this marginal rate toggle, we currently have 24% in here by default, but clicking on this cell, this individual is actually estimating 25%, because remember, they said they're estimating about $50,000 of incremental tax specific to the Roth conversions. So in case you're not seeing the calculation, here's the $200,000 conversion, here's the 25% incremental tax that is expected, and that is how we calculate $50,000 of incremental tax on each conversion. Now, looking over here for the moment at the Roth IRA tracker, the amount of Roth conversion after taking out the withholding is what will actually end up in the Roth IRA. So in this case, it's $150,000 is the estimate each year, based on a $200,000 annual conversion, less $50,000 of withholding, which is coming out of the distribution. As the person's financial advisor put it, that $50,000 is coming out of the RMD money. In other words, it's not being transferred from the traditional IRA into the Roth IRA over here. This part is going to the government in the form of withholding, and only $150,000 in this example is ending up in the Roth IRA. Okay, now just a couple of minor points before we move on. In this example, it seemed pretty clear that the individual intended to withhold the entirety of the incremental tax. However, if they wanted to use outside funds, and that means using money that is not coming from the distribution out of the IRA, it's simply using funds from some other source to cover the incremental tax. If they wanted to do that, which they did not state in the fact pattern, I am just straying from the fact pattern just for a moment for purposes of completeness, but clicking right here, if they wanted to use outside funds of, let's just say, $20,000, then the amount of withholding on this distribution could decrease to $30,000, resulting in an additional $20,000 ending up in the Roth IRA, because remember that the more you withhold from the distribution, the less will ultimately end up in the Roth IRA. And so in some situations, if you want to maximize the amount that ends up in the Roth IRA, you might consider paying some or all of the incremental tax with outside funds if that is possible in your situation. In other words, if you have the outside funds available to do that and desire to do that. But the point from a mechanics perspective on how this is working, the amount of withholding determined in this column will be decreased by the amount of outside funds that you enter into this column. But again, for this example, that is not applicable, so I'm going to put that back to 0. Now, what about this marginal tax rate up here of 25%? Well, remember that when you do a Roth IRA conversion, the conversion income is going to be taxed at the margin, meaning whatever the highest rate is that is applicable to you as you move along and fill up the brackets. So this person might very well be in the 24% marginal bracket in these particular years when they are doing Roth conversions. However, if we hop over here to the main tab for a moment and we look at this year right here just as an example, if we were going to do a Roth conversion of $200,000 in this year, then the brackets would get filled up in similar fashion to these 5 years right here when we are actually doing the conversions. And so the marginal rate when we're starting out is actually 12%. The marginal rate is whatever the highest rate is that you are subject to at the moment. But as soon as you fill the 12% bracket with Roth conversion income to the extent that it can hold income, we will then bump to the 22% bracket. And so that portion of the Roth conversion income is being taxed at the margin at the 22% rate. And then finally, if there's enough income to bump us into the 24% bracket, which certainly does appear to be the case in this fact pattern as I have it set up, then the remaining Roth conversion income is being taxed at the margin at 24%. But in total, the Roth conversion income is not all being taxed at 24%. It's being taxed at some effective tax rate that lies between 12% and 24%. And let's also remember that this person is probably factoring in state taxes, which could be a few percentage points there. So they are estimating a grand total withholding of 25% in this situation, which for this fact pattern I would view as reasonable. It's not going to be the exact number, but it's going to be a reasonable estimate for purposes of how much withholding you want to take out of the distribution. And of course, remember, if this person is doing federal and state, then within their brokerage account where they identify how much of the distribution goes to withholding, they will have to separate it out most likely into 2 different buckets, one bucket going to federal, one bucket going to state. But in total, the amount this person is estimating to be a combined $50,000 per year. So that is how we deal with the calculation of withholding coming out of the distribution for purposes of reducing the amount of distribution that ultimately ends up over here inside of the Roth IRA. However, let's do a pop quiz for those of you in the personal tax planning template program. Does the withholding in this column right here for this cash flow analysis impact your calculation of estimated taxes for the year? And the answer is no. For estimated taxes, we have to go to the Safe Harbor Estimated Tax Calculator, which is included with the personal tax planning template program. Okay, so here we are on the Safe Harbor Estimated Tax Calculator. And my question for you is, where does the withholding go and how much withholding do we put there? Well, the first answer is that withholding for the current year, whatever amounts you have projected for the current year from whatever source, those amounts are going to go into this cell right here. And remember, that is for the current year only, because when you're calculating your estimated taxes, you're only working on the current year. Dealing with estimated taxes is a year-by-year item. It's not something that we're going to project out into the future. So based on the numbers in the example we have been working with, what number goes right here? Now, if you said $50,000, you might be right if this person was basing this 25% withholding on federal only. But let's say that this estimate of $50,000 of withholding actually included some for state and some for federal. Let's just make up some numbers. Let's say it was $46,000 for federal and $4,000 for state. In other words, those are the actual amounts of withholding that this person remitted to the federal and state taxing authority when they were completing this distribution. Then coming back over here, what I would put into this cell is not $50,000, but rather $46,000, because this safe harbor estimated tax calculator is for federal taxes only. Now, you could make a copy of this tab right here, and you can create another calculator for states. And if this was the state version of this calculator, then what number would I put in there based on this fact pattern? And the answer would be $4,000 if that was the amount of state withholding in question. Now, putting this back to $46,000 for the moment and assuming we're working on federal, based on all of the information that you see right here, does this person need to make an estimated tax payment in Q2 of this year? And the answer based on these specific numbers is no. This individual, based on just the numbers that are here, is overpaid in Q2 by about $2,000. They are overpaid in Q3 by about $500. And then, if nothing else changed, by the time they got to Q4, which would be January 15th, 2027, they would currently be underpaid by $1,195. And so for this fact pattern, they would have to make a payment of at least $1,195 in order to avoid underpayment penalties and interest related to the underpayment of estimated taxes. All right, so with that, summer 2026 tax planning with the personal tax planning template program is in full swing. If you are already a member of the program, hop down into the description below this video and test your skills with the 8 warm-up quiz questions plus the 2 mega brain scramblers. And if you don't get every answer correct, then I want to hear from you, because clearly we must have a gap somewhere in the training content if my number crunch nerds don't nail every single answer. And if you're not already a member, take the quiz anyway and see where you stand. Because remember that the IRS doesn't care whether or not you understand your options. If you are a U.S. taxpayer who owns pre-tax retirement accounts, you will be taking the RMD exit ramp into retirement. And that's whether you like it or not, and whether you know it or not. The option is not whether you are going to take the RMD exit ramp. The option is who controls the speed at which you must ride. The IRS can control the speed, or you can control the speed. Either way, someone is going to be controlling the speed at which you take the RMD exit ramp into retirement. And the choice about who is going to control the speed is up to you. The Personal Tax Planning Template Program is the vehicle that helps you move from an exit ramp filled with uncertainty, surprises, IRMA hits, and overtaxation to an exit ramp filled with confidence and clarity presented by the numbers, with no guessing, wondering, or fingernail biting required. Join the program today with lifetime access for a one-time access fee, and you will receive what is, without a doubt, the most comprehensive, accessible, and frankly enjoyable individual income tax training program on the market in the United States today. Download the program, follow the Roth IRA conversion flowchart, binge watch the extensive training content, and make 2026 the year when you finally understand how to save your family meaningful amounts of money in taxes, just like the professionals. You can find a link to join the program in the description below this video on YouTube, and I look forward to seeing you inside the class.